with a turnover above 1 billion euro, and which has a reference rate which is reminding us some souvenir, because the reference rate of the corporate alternative minimum tax is 15%. So when you try to assess what is the effective tax rate of a US MNE, the answer is not straightforward. And most studies tend to show that it varies to a bit below the reference point that we have in Pillar 2 to significantly above, depending on the sector. The other difference that we face, which is a very clear one and easier to understand, is a difference in the so-called blending approach. That is, the United States system works with a global average, and therefore the insufficient taxation in some jurisdiction can be offset by the significant taxation in high-tax country, while Pillar 2 works with an average country by country where you cannot offset your taxes. So there is no doubt that Pillar 2 is more efficient in disciplining the zero and low tax jurisdiction and incentivizing them in introducing a minimum taxation. But from a company point of view, the two systems, both the US and the OECD one, do have a pretty similar system, which is effect, which is ensuring a minimum level of taxation, because the effect of the global blending versus Pillar 2 is not on the absolute level of taxation, but rather on where taxes are paid. Fourth, we focus a lot in the European Union on the complexity of Pillar 2, and indeed this is a very heavy and difficult to understand set of rules. And for this reason, sometimes we always tend to assume that the grass is greener outside, you know? And that the US would have a comparative advantage with their own system. Well, actually, my advice to anyone holding this line is read the US legislation. The combination of guilty, beat, and canty and the guidance of the IRS is 1,725 pages. 1,725 pages. They use different accounting rules depending on the legislation concerned, sometimes financial accounting, some tax accounting. So in terms of complexity, it's even worse than Pillar 2, actually. I'm not saying this to praise the complexity of Pillar 2, but just to give it in perspective somehow. So we have started this discussion on the side-by-side. The idea would be to refrain from applying Pillar 2 to the US headquartered company and their subsidiary. This brings, obviously, a lot of questions, and other jurisdictions are asking to consider an agreement which would not be US-centric, but which would have clear criteria for accessing a kind of side-by-side approach. It is difficult to have a clear prognosis on where this discussion will land, and it is also obvious for us that whatever agreement comes will need to be accompanied with clear safeguards. To give an obvious example, if today we can consider that the taxation of US MNEs, let's say, is roughly equivalent to the one that we ask to our own companies, we need to be sure that 1 year down the road, 2 years down the road, or 3 years down the road, the United States will not come with a much different rate, which would be much lower, because that would change completely the picture. So if there is an agreement, it cannot be an agreement forever. It needs to be an agreement under certain conditions. At the same time, we need to do our homework. We hear a lot of criticism from both the business community and the tax administration, which shares the same view, which is it's complex, it's heavy. As you know, we have started the discussion on permanent safe harbor. That is a permanent set of simplification of Pillar 2. And that is certainly a very important priority on which we need to focus our efforts. Now, to go back 1 second to the side-by-side, it begs also the question of how we do it. We cannot, under the directive, consider the US system as equivalent. Because to consider it as equivalent, one of the conditions set by law, which is to have a country-by-country approach, is clearly not met by the US system. That is why our preference would be to try to construct it via a safe harbor, because in the directive you have dynamic link with whatever safe harbor may be agreed by the OECD. So if it is constructed as a safe harbor, we don't even need to change the directive. It does not mean, nevertheless, that all pressure is out, because we don't have to change the directive at union level, but member states do have to change their national legislation. Because by law today, the under-tax profit rule does apply to US companies on the 1st of January. So if we want to change it, it means that we need first a very quick agreement on the safe harbor at the OECD. And I don't know whether we will manage because we're in the middle of this discussion. And then 27 member states to change, or at least 22 because 5 have a delayed implementation, to change their legislation at light speed, which is certainly very challenging. We're all trying to discuss in good faith, in earnest, trying to get a balanced deal. It's challenging and the clock is ticking, but the will is there. Thank you.
Thank you very much, Mr. Angel. And then I will move to Mrs. Kimberly Clausing, who is joining us online for introductory remarks.
Thank you so much for having me. Honorable members of the Fifth Subcommittee, I'm pleased to address you today. This time is a deeply challenging one for all facets of international economic cooperation. The world is facing so many crucial global collective action problems: climate change, public health, maintaining a rules-based and open trading system, and of course the twin problems of tax competition and tax base erosion. While today we're focusing on tax, these problems have a common element. They're all areas where there's broad international consensus about the importance of the problem and the necessity of policy action. But there are also areas where international efforts are often stymied by free riding. These are areas, indeed, where European leadership is crucial both now and in the time ahead. Tax competition and tax base erosion are problems best solved through international cooperation. Otherwise, as has long been true, havens provide rock-bottom tax rates and favorable regimes, and they lure economic activity and profit away from most other jurisdictions. This is a large, well-documented problem. Worldwide, over $2 trillion of multinational corporate income is taxed at a rate lower than 15%. Huge profits are booked in very low tax jurisdictions that are entirely disproportionate to economic activity. Addressing this problem is important for the integrity and sovereignty of national tax systems, especially today when we have ascendant populism and too many people feel shared prosperity is out of reach. Building fair tax systems requires taxing both labor and capital, and this includes the excess profits of multinational companies. Business tax is an essential way to reach income from capital and profits, and a broad tax base is important for both revenue and progressivity. In addition, profits taxes can be efficient since pure profits are non-distortionary. Simply put, the same business decisions will maximize both pre- and post-tax profit. Because the corporate tax base is so important, international cooperation is crucial. It enhances tax sovereignty by protecting the ability of countries to collect their own tax revenues without fears of declining competitiveness. Most jurisdictions throughout the world lose revenue to a tiny number of jurisdictions with really low tax rates. The Pillar 2 agreement has now been implemented in more than 40 jurisdictions, and it's an important step to addressing this problem. Jurisdictions implementing the agreement include many important countries beyond the EU: Japan, Korea, the UK, Indonesia, Australia, South Africa, Switzerland, Singapore, and Turkey are just a few. But implementation also includes several offshore jurisdictions that previously offered very low tax treatment. Under the agreement, there is the aspiration that all multinational corporate income should be taxed at least 15%. Of course, there are complexities and caveats, but the agreement is an important first step toward better tax cooperation. Estimates suggest that Pillar 2 could reduce profit shifting by about 50%, increasing corporate tax revenues across every country group except havens, and on raising nearly $200 billion per year for governments. To tackle global collective action problems, it is important to address free riding. This is difficult to do, but the Undertaxed Profits Rule, or UTPR, helps adopting countries withstand the pressures of tax competition. And it does this by treating all companies that operate in adopting countries on a level playing field. As such, the UTPR helps countries regain their tax sovereignty, enhancing their ability to tax multinational activity within their borders without being undermined by the profit shifting of companies in non-adopting countries. At present, the United States government is taking positions that make international tax cooperation far more difficult. With respect to the Pillar 2 agreement, the United States has promoted this two-track system that we just heard about. Under the two-track system, U.S. companies would receive special treatment relative to firms based in other countries through a side-by-side system that would count U.S. minimum taxation as compliant with the global minimum tax, even though the U.S. regime is weaker in key respects. I agree that it's more complicated, but the United States minimum tax regime doesn't include a country-by-country determination of minimum tax. And that feature is very important since it strengthens the effectiveness of minimum taxation. Without it, a country could have a client state that has a hyper-low tax rate and that allows them to blend their income from higher tax jurisdictions and achieve a much more favorable outcome than they would under country-by-country. This stance puts the more than 30 jurisdictions that have adopted the UTPR in a very difficult position. While one option would be to simply apply the UTPR to U.S. companies, such a stance risks a delicate balance of cooperation with the United States, and this is particularly necessary, of course, in the security realm. Likewise, the use of digital sales taxes, as well as other elements of EU tax and regulatory regimes, have been challenged by the Trump administration. They have threatened tariff escalation, a revenge tax, that's the Section 899 tax, and reduced cooperation in unrelated areas. While the revenge tax isn't a credible threat, since it would be nearly impossible to get through Congress and violates budget rules, this general approach is deeply misguided. Using threats to address other countries' sovereign policy choices leaves U.S. trading partners with a difficult balancing act, particularly when they negotiate alone and do not coordinate. While the best path forward is uncertain, it is important to preserve the possibility of enhanced international cooperation on important global collective action problems, especially down the road. This means preserving global minimum tax efforts and working to both simplify and strengthen that regime in the years ahead. Among the present pressures of fragmentation in the world economy, it's enormously important to preserve international cooperation, and this includes on issues such as climate, public health, and a free and open trading system. So I thank you for your work in this regard, and I look forward to answering your questions.
Thank you very much, Dr. Klossing. And then I hand the floor to Mr. Vinas de Sousa for introductory statements as well.
Many thanks, Chair Peter Hansen, for both the invitation and for the pleasure of sharing the floor with you. I feel a great urge to agree with many things that my dear former colleague just said. I will strongly resist the urge to do so. Now, I would like to start by saying very clearly that the main aim that we should have in terms of our taxation system is safeguard the competitiveness of European companies. That really must be a central objective of EU tax policy. This is vital not only for companies themselves, but for the whole of the European economy, all of us as citizens of European countries. It's vital for jobs, it's vital for the maintenance of our social model, it's vital for us to achieve all our security and geopolitical ambitions and necessities given the current environment that we face. The competitiveness of the European economy is a long-standing problem that we must face, which now is under additional types of threats. the geopolitical instability that we are all having to address, higher overall costs, the regulatory complexity, and persistent and increasing trade frictions. They are all threats to all our way of life. Now, on the top of all that, we are dealing here with an additional complication, which is the enormous degree of instability on the global tax system that we are now having to address. In particular, the United States' retreat from international commitments risks puts Europe at an additional disadvantage if we do not act decisively, regardless of the comparative level of actual complexity. And I say that as someone that actually pays taxes in the United States. I have an accountant. So Europe simply cannot afford to be in this situation without doing anything. The instability of international tax must be acknowledged and consistency across all jurisdictions which are relevant for us pursued. The EU, therefore, must first and foremost assure that its own tax framework supports growth and investment rather than holding it back. We certainly have much more capacity to correct things that we have problematic in our own house than in other jurisdictions. Now, allow me to start by saying, beyond these introductory remarks, that we always supported at Business Europe efforts to combat tax evasion, aggressive tax planning. We backed effectively the implementation of the OECD G20 BEPS framework and the two-pillar solution, but on the understanding that all jurisdictions would move together. And we warned, as a matter of fact, both the Commission and the co-legislators against a rushed adoption of this type of a framework. Global adoption has simply not happened and, frankly, is very unlikely to happen. So unless this is addressed, this will further undermine European competitiveness, something that we must stress clearly. When Pillar 2 was agreed in 2021, this was hailed as, correctly, a milestone of global cooperation. Today, the sad, hard truth is that uneven implementation turned it into a risk factor for the European economy and for European companies. Fewer than half of the jurisdictions have actually legislated Pillar 2. Major players beyond the United States, like China, like India, are either outside of Pillar 2 or have an uneven partial alignment with it. The G7 side-by-side approach effectively will mean that U.S. companies are spared of many of the burdens that European businesses face. This creates naturally an asymmetry and distorts competition, which is supposed to be beneficial for economic growth. Now, if Europe imposes stricter obligations than its main trading partners, we may quibble around the definition and the level of complexity. The practical result of that is that this will weaken further our position in global markets and compromise our ability to deliver on what we need as a continent, our priorities. Now, there are many ways in which we can address that. I think that none of us would accuse the European tax system or the American, as a matter of fact, of being easy, quite the contrary. But we control our own tax system. We don't control the American one. Current system in Europe is too complex. Compliance, reporting costs, we just managed to have the report that our counterparts at the Danish presidency produced so helpfully for us in terms of the costs of legislation. The laudable goal of the Commission in terms of reducing report requirements is very much welcome from us. The fleet of omnibuses is something that we are all running to try to catch. But simplification must not be just the relabeling of provisions that fall short of real progress. Genuine simplification, again, something that we control as opposed to the tax system of other jurisdictions, must imply that we ensure transparent and meaningful consultation with stakeholders, ex ante, not just ex post. That we should tackle long-standing barriers for cross-business, particularly in terms of areas like withholding taxes, for instance. I can give you an example, an area that will be relevant for you, which is the Savings and Investment Union, as a matter of fact. Think in terms of how it would be operationalized if you have divergent withhold taxes between member states. All right? Proper functioning of tax treaties, removal of obstacles to cross-border investments within the European Union, things that we, in principle, control. are everyday hurdles that we, European Union companies, the backbone of the European economy, face every single day. These truly are priorities that we have been warning about for literally decades and remain unaddressed. An horizontal approach across policy areas that eliminates duplication between effectively what are tax and non-tax rules is also clearly necessary. Evaluating with the existing EU tax requirements are really necessary, or the ones that are not really delivering value for money, to eliminate those. Strengthen dispute resolution mechanisms. These are all things that in principle we control. So the real question for us, outside of comparisons with happens with other jurisdictions, is how do we improve the climate for business in the European Union? We again very much welcome the Commission recommendations for cost-effective and timely tax incentives in areas like, for instance, the Clean Industrial Deal. They are encouraging, but we also need more clear guidance in areas like that. We would like a real emphasis on simplicity, cost-effectiveness, timelessness, and alignment of state aid rules, principles that are all clear and core for businesses. We should be thinking of a European approach that promotes, for instance, accelerated and depreciated expensing of liabilities, strengthening our cash flow, reducing upfront liabilities, introducing tax credits that actually support investments, for instance, in clean and digital technologies, and support member states who ultimately hold the authority with practical guidance and best sharing practice. We also would like to assume that we understand that we should avoid a system that creates new taxes, be those of a digital or core types of frameworks. Now, these are the true favorable conditions that Europe must put in place to attract traditional and innovative companies for investment into our continent. They should enable smaller and large businesses to support our economic way of life. Now I'm going to finish. I again compliment all the efforts of the Commission, and I look forward to supporting them in the future. We cannot afford to follow further in terms of global tax competitions. If we do not, we know who is going to win, everybody else but us. I will give an example on the Draghi report. I had the privilege of being there with my president when we had a discussion on the implementation. When he was asked what has happened in terms of implementation of the Draghi commitments in the past year, essentially he gave the reply that all companies tell us, nothing real that affects the day-to-day life of our companies. That may be sounding harsh, but is an honest explanation of where we find ourselves. Business Europe, therefore, urges the EU leadership to show commitment to deliver a workable, simplified, balanced tax framework among the member states, the variables that we control, one that safeguards European competitiveness and ensures that Europe remains an attractive place to do work, to invest, to do business. Therefore, for us companies, the message is clear. Europe must deliver on competitiveness now. Otherwise, investment, growth, jobs, innovation, they will happen somewhere else, not here. Thank you for your attention.
Thank you very much for your remarks. And lastly, I pass the floor to Mr. Quentin Parinello, who is also joining us online.
Thank you very much, Madam Chair, and thank you very much to the FISC Committee for the invitation. I apologize for not attending in person today. I had a last-minute personal issue that prevented me from being with you today. We are asked to talk about the implication for the EU of the Trump administration's tax policies. And as I show in the next slide of my presentation, it has been a remarkably busy year on the front of international tax cooperation. A lot has been said already by previous speakers about the US budget proposal reconciliation bill featuring the Section 899 so-called revenge tax that would have threatened both European businesses and European citizens with punitive taxation. The G7 agreement committing to neutralize part of the OECD minimum tax on corporations and allow a side-by-side system where the US current regime stays as it currently is, and new tensions over the summer rising on digital service taxes. We're still in September, so it's not the end of the year. And as Benjamin Angel was pointing out, the OECD is working against the clock to deliver guidelines on what a side-by-side system would look like before December, to make sure that both the European Union and European member states and other countries that implemented Pillar 2 can adapt to the new side-by-side system. What we witnessed over the past few months is nothing less than the US and some of their allies challenging the consensus, the imperfect consensus that was forged over the past 10 years on the need to tackle tax avoidance by multinational corporations. And it has profound implications for the EU in terms of tax fairness, fair competitions, and potential revenue raiser reforms. So I wanted to focus my opening statement on the implication of the transformation of Pillar 2 pushed by the Trump administration and the implications, of course, for Europe. Next slide, please. So first of all, I think it's important to remember the objectives of the Pillar 2 reform. That global minimum tax of 15% pursued a number of objectives on putting a floor to tax competition between multinational companies, and the previous speakers has been very eloquent in reminding the need to make sure there's a stable and fair competition between European businesses and US businesses, but also to limit harmful tax competition between multinational companies and SMEs, who often face higher tax rates. It's not only a matter of competitiveness, of course, it's also a matter of tax fairness and tax morale, making sure that the winners of globalization, so to speak, pay at least a minimum amount of tax, strengthen the ability to collect taxes from the rest of the population. So that was also a way to reduce profit shifting, strengthen tax morale. The main achievement, the crown jewel, if I could say, of that achievement was the design of interlocking rules. In plain English, interlocking rules were made to make sure that companies are taxed at a minimum rate, even if one country does not implement the agreement. So there were a series of 3 rules with barbaric acronyms: QDMTT, income inclusion rules, and under tax payment rule, that ensured that a company would pay a minimum of 15%. Let me give you a fictional example. Imagine a Canadian company selling shoes in Germany and shifting part of the profits to the Cayman Islands, where their IP is. In theory, the agreement enabled the Cayman Islands to tax the income shifted there at 15%. But should the Cayman Island not implement the deal, then Canada could implement a 15% minimum tax. And if Canada did not implement the minimum tax, then Germany was able to collect it. That tax collector of last resort gave a level playing field to the agreement, even if some countries did not implement the deal. This was the crown jewel architecture of the agreement that sort of reversed the notion of tax competition to have a tax competition based on fair taxation, but also a tax competition based on who has the best infrastructure, the best workforce, etc., etc. Now, because the rule was implemented, the agreement was thought to be implemented on a country-by-country basis, what we call jurisdictional blending, there was, in theory, little incentive for one country to sit this out. We estimated at the EU Tax Observatory that it could have generated around 75 billion euros annually. Now, of course, the G7 deal is set to change this architecture. Next slide, please. Let me come back to the very same example of a Canadian company selling shoes, I think, in Germany and shifting part of the profits to the Cayman Islands. In that context, of course, the Cayman Island can still raise the minimum tax domestically. Canada could implement either the global minimum tax deal or an equivalent system, and Germany is out as soon as the equivalent system is implemented. Now, the OECD is working on the eligibility criteria for equivalence, and it's difficult to comment as the negotiations are ongoing, but it's difficult to find a perfect match in equivalence. And of course, we are all wondering, because that equivalent system, as Benjamin Angel said, was designed also to accommodate the existing US system. The question everyone has is whether the US system is equivalent or not. Next slide, please. So a lot has been said both by Benjamin Angel and Professor Closing, so let me just focus on 4 different points that are important to remember. The first one is the rate. In NCTI, the new name of GILTI, which is far more difficult to remember than the acronym GILTI, the rate is likely to be approximately around 14%, so lower than the 15%. We have 2 main differences in terms of tax base. One on the accounting rules. Pillar 2 is on book income, and NCTI would be on taxable income, and the other one on the existence of substance carve-outs, which means exceptions to the tax base on whether you have investments in real economic activity assets, physical assets. And finally, the last one that was mentioned by a number of speakers before, the blending, whether you apply the rule nationally or globally, or at jurisdictional level or globally. This is likely to be the biggest change, also in terms of incentivizing countries to adopt the minimum tax. In my example, the fictional example that I gave before, there is much less incentive for the Cayman Islands to actually implement a minimum tax with global blending, which means that there's an impact on the ulterior effective tax rate of the companies, but also we remain in a system where there is pressure for countries to keep cutting their corporate income tax, which was severely limited by Pillar 2. My take on this is that without a full economic analysis, it's very difficult to have a nuanced understanding of the equivalence. But at least 3 out of the 4 points that I'm giving you here would tend to give a lower tax rate to US businesses under US rules than European businesses under a global rule. So it looks very hard to give an equivalence right now, right away, to the US tax system without further work. Next slide, please. I want to leave this conversation with 3 final points. The first one is that the G7 agreement was the consequence of the fear of the economic impact of distorting tariffs on European businesses. And there's very good analytical work on the potential economic impact of tariffs. But the economic impact of dismantling part of the minimum taxation rules should not be underestimated. It's not only about the direct revenues that the minimum tax would raise. It's important in terms of competitiveness of European businesses, and it was stressed by the previous speaker. It's important for fairness aspect between multinational companies and SMEs, but it's also important in terms of tax morale. So from that perspective, the question is, should we suspend this agreement, or should we align European rules to the US rules? I would disagree with this. The rationale for minimum taxation is still there, particularly the fact to have fair taxation rules between multinational corporations and SMEs. The rationale in limiting the race to the bottom in corporate tax is still there. The need for additional revenue is still there. The need to strengthen tax morale is still there. So there's still a rationale for strong minimum taxation. And finally, my last point, which is likely outside of the expertise of the observatory, but more of an outside commentary, is how stable is this compromise? And Benjamin Angel pointed it very eloquently, I think. You need 2 reliable partners to strike a compromise. And if the cost of renouncing to strong minimum taxation rules, at least for US companies, was to prevent the so-called revenge tax from being implemented, it seems very problematic to see the Trump administration threatening to bring it back every other week, whether to threaten countries implementing digital service taxes or to pressure the OECD on the equivalent system they're designing. In that context, setting anything into stone seems a bit premature, and we need to have a bit of flexibility. And I'll leave it there. Thank you very much.
Thank you very much, and thank you in general to all the speakers. We can now enter into the Q&A. Now we got light as well. The Q&A with the FISC members. So we have 7 speakers on the list, and we have only half an hour left. At 5, in case we go over time, we will do a swap with Regina Rota as the second vice chair. But please keep in mind the time in sake of everyone. So the members will have 2 minutes for their questions, and the speakers will have 3 minutes to answer. But you are clever people, so I expect that you can do that. And with that said, I would give first the floor to Mrs. Danush-Nebudova for the first question from EPP.
Thank you very much for very nice presentations. Well, I think that we are still living in the old paradigm that we have to tax everything what is moving. I think that the magic word Draghi report has been mentioned several times here, and I really do welcome the words of Dr. Sousa, because he was the only one who was talking about the creation of the environment for the business in Europe. Because, ladies and gentlemen, I do not think that we are talking about profit shifting anymore. We are talking about shrinking of the tax basis in Europe, and this is what we have to avoid. And my question is in this connection, about the implications of the custom tariffs imposed by US on China, because the European market is very sensitive. My country belongs to one of the fewest countries which are much more sensitive on the tariffs between US and China than the tariffs between US and Europe. And we are really facing our companies are facing very hard competition due to our orientation on export and a very close ties with Germany. And I am asking, and my question is especially on DG Taxit, because the regulator is always one step behind. And it seems to me that now is the situation, we are like 2 or 3 steps behind. Do we need the new fiscal tools to support? Do we need further international tax coordination to avoid the spillover effects of this trade war between US and China on the European companies, on the internal market? And I don't want to hear that we need more regulations, because we are regulating. We created such a complex tax environment in the world that, in fact, there are obstacles for the businesses in the tax world because of the BEPS, because of Pillar 1, because of Pillar 2. And I'm not talking about big companies, I'm talking about small and medium-sized companies, because they really face the barriers on the internal market due to the tax complexity, which is currently in force in Europe and in the world. Thank you.
Thank you very much. I think it was directed to Mr. Angel, and if the others would like to respond, let me know, but I hand the floor first to you.
It's a difficult question. First, let me state the obvious. We don't have much experience yet, because we're talking of a very recent decision, and economists like to have long time series before making any assessment of the effect. Everything can be seen in a different manner. I know that there is a fear that Chinese exporter might reorient part of their export to the European Union because the US market is more difficult to access. At the same time, for the US company, which were in direct competition with Chinese company for accessing the US market, now they face a situation where their relative competitiveness has de facto improved compared to the Chinese. So which effect will prevail? Honestly, at this stage, I don't know. I don't think anyone does. We will see more clearly in a couple of months, also because the current tariff situation is very volatile, and most likely the US and China will continue their discussion. I cannot say more because I'm not in charge of trade or customs. I'm in charge of taxes anyway.
Many thanks for the question. Our position in relation to international trade negotiations is clear. We expressed it in our own reaction to the trade deal between the United States and the European Union. If there is one thing that is positive about it, is the fact that it adds clarity to what our companies should expect. This is not an endorsement of the deal in and of itself. It's to eliminate uncertainty, because uncertainty is never good from the point of view of a company. I would like to make a reinforcement on the point that my colleague here just stressed, is that in relative terms, if everybody else is faced with greater taxes to access American markets, those that are relatively less additionally taxed actually may face in some areas and in some sectors actually an advantage. But there is one important point in relation to this rationale, which is the rerouting of Chinese exports that would not have reached the United States to other markets, notably the European Union. You can make a case that that is already being observed in some areas. And there, the policy reaction should be the European Union to use its several available, strengthened in the past few years, trade defense mechanisms to protect the European market from unfair competition from third markets which export goods to us at low costs, goods produced with government subsidies which we are not allowing to be used on the European Union territory. So those are things that are within our capacity to react to this type of shocks. Many thanks.
Thank you very much. And I look towards the speakers online and I ask you to maybe use the raised hand function in case you want to jump in on a question. In that case, I pass the floor to Mr. Niels Fuglsang for the next question.
Thank you.
Okay, vil du bruge mikrofonen?
I'd like to use the microphone, please. I'd like to thank you to the speakers and thank you to you, Chair. And I'd like to start by saying I agree with with my good colleague from the EPP that we need to do more about reducing the complexity of the tax system, as that it can indeed be an obstacle to our businesses. But I think, and this is where I disagree with you, that it's extremely important that we do whatever we can to try to stop this profit shifting from happening. I think a lot of citizens are looking at, when they look at their own tax bill and they look at how much profit is being shifted and tax being avoided, or tax payments being avoided, they look at that with anger, and I think they're right. They're doing so rightly. I also think when you look at the right-wing extremist movements in Europe, that I'm a political scientist myself, wrote a PhD on this, that you can see that there are also economic reasons for this. When people when the inequality is rising and some people are earning a whole lot of money and not paying taxes, I think a lot of people will be disappointed with the system, and we need to fix it. So as far as I understand your presentations, there is a trade-off in this deal. We want a deal with the US. We want this Pillar 2 system to work. But doing this kind of deal with the US also gives the US companies an advantage, because their system is not as strict as the Pillar 2, as far as I understand it. And that can remind me a little bit of the trade deal, with the so-called trade deal that we did with the US, giving them a big advantage because we are in a weak position and we need to get them on board, but we cannot force them on board, obviously. So maybe you can comment on that. Is that the kind of dilemma you see, that I see here? And among the 4 points that you mentioned, the differences between the U.S. system and the two-pillar approach, I think it was the last speaker, Mr. Perinello, who had this slide with the 4 points. What do you think is the most serious weakness among the 4 points when you look at the U.S. system compared to the two-pillar approach? Thank you.
Thank you very much, Niels. And I invite first Mr. Perinello to reply, and I see also the hand of Dr. Clausing.
Thank you very much for the question. It is at this stage slightly difficult to give you an order of magnitude, because we lack back full economic analysis, because the changes to the US legislations are extremely recent. They were adopted over the summer. However, we do have data, and I believe Professor Closing will be more eloquent than me on this because she worked on this, on the blending. So if we come back to the example of the blending, a US company could still book profits and not pay 15% of taxes in a number of jurisdictions under their legislation, when a European company would not, to the understanding that the average of their profit would still reach 14%, so not exactly 15%. So that difference in blending between a jurisdictional blending and a global blending constitutes an enormous disadvantage that was, I think, summarized in US papers in terms of economic advantage to more than $100 billion, but I will refer to Professor Closing for the correctness of what I say. And particularly if one of the aim is to tackle profit shifting, the incentive for a country, a low tax country, to raise their tax to the global minimum agreed level is much weaker under a global blending than under a jurisdictional blending.
Thank you very much. And I pass the floor to Dr. Closing as well online.
Anger in this area, because the current status quo, which involves so much profit shifting, really does create unfairness in the tax system, and in fact undermines our ability to tax capital income at all, because it often goes untaxed at the individual level. When we're looking at the U.S. system, I think there's a couple key things to keep in mind. One is that if the U.S. system were equally tough, we wouldn't have to worry about U.S. firms paying the UTPR in the first place, and so there'd be no reason to object to it. The very fact that we're objecting so strenuously to the UTPR is showing you that the U.S. system is weaker than the country-by-country Pillar 2 system. And when we look at the recent legislative changes, you can see that there's over $160 billion over 10 years of new tax cuts for multinational income, for the foreign income of U.S. multinational firms. Now, some of these are very arcane, small provisions that might be difficult to understand, but when you look at that net revenue impact, it's telling you that U.S. multinationals are getting a big tax cut from this recent legislation. So what I worry about is if we completely move to this side-by-side system, the United States won't be the only one who gets this unfair advantage. In fact, we'll kind of undermine the whole rationale for the international tax agreement. So you could imagine the United States working with a client state to get much lower worldwide tax burdens. But the same is true for China. China could work with client states to get to a better outcome through global averaging than could be held through, the Pillar 2 system. So I think the UTPR was really a crucial bulwark against that kind of erosion, and the whole international tax agreement really requires, the implementation there. I realize that the European Union is in a very difficult position to strike a balance here between, trying to get the certainty from these agreements and trying to maintain the integrity on international cooperation to make it last. So I guess my policy suggestion would be to try to make concessions temporary so that these provisions can be resuscitated in their full effectiveness down the road, even if there's a partial effectiveness in the meantime.
Thank you very much. And I hand the floor to Mr. Angel.
Thank you, Kira. I would take a more nuanced view, actually, than the two previous speakers. First, as I explained, I don't think there is a significant difference in terms of effective tax rate, and all the studies show that they're sometimes a bit below, sometimes above. Second, in terms of administrative workload, the US system is even more complicated than ours. Now, on the question of blending, I'm not saying that blending does not matter, but I think it matters for a different reason than the one you have stressed. I don't think it matters from a group point of view. Let me take a simplified example. Imagine a company which is present in 2 countries, equal activity in the 2 countries. A company subject to Pillar 2, in those 2 countries, it is taxed at 15%. A US company, in one country, it's a tax haven, no CAT, 0%, and the other country where it is, it's taxed at 30%. It's in China. Well, in average, both companies face 15%. So from a group point of view, there is no difference from the fact there is blending in the one case and no blending in the other case. Because in the US system, if you're 2 present in a zero tax jurisdiction, you end up having to pay a top-up tax, the same way that you would in Pillar 2. Where blending does matter, and here I fully agree with Kimberly and Quentin, that is for creating an incentive, together with the UTPR, for the country to either introduce a corporate income tax or face a situation where someone else will tax anyway. So in doubt, you'd better introduce what we call a QDMTT, that is some form of taxation, because there is no risk of trying. In the worst case scenario, companies are moving, but they would be moving anyway. Best case, many will stay, and you get some tax income. That you get because of the lack of blending in Pillar 2, and you don't get in the US system. So the OECD is more efficient in leveling the playing field, but since we were talking of competitiveness and effect on the companies, I would hold the view that blending or not blending, the effect is roughly the same.
I stressed before that I'll do my best not to agree with my colleague, but unfortunately here I would have to surrender and concur with you. The discussion here seems to imply that there is an unambiguous difference between the systems that would lead to, inter alia, an increase in quote-unquote profit shifting. We actually don't observe that because of the degree of comparability between the 2 systems. If anything, the feedback that we have from European business is that the introduction of BES-related actions have had fairly limited impact in terms of the established practices in terms of structure, financing, transfer pricing, or investment decisions. The real question that was affected by the introduction of those mechanisms was on the regulatory burden associated with the tax mechanism, not necessarily in terms of the behavior in and of itself. So, I mean, the message here would seem to be that when you look at the effects of the 2 systems, it's not clear that there is a significant difference in terms of the behavior that you want to affect.
Thank you. And with this, we move to the first speaker, Enrico Guri from the PFE.
Okay, thank you very much. Well, my conclusion from all the presentation and the situation that has evolved is that the European Union doesn't really need external enemies. We are here. We are the greatest enemy for ourselves, so we represent the major risk for our own competitiveness. It sounds like a joke, but it's not a joke. It's terribly serious. So I don't have to quote Mr. Draghi. Some of you have done it. So we have maneuvered with the Commission in the lead to us into an impossible situation. Because we wanted to save the world, we wanted to be the champions of tax fairness. Now we have a beautiful Pillar 2 directive implemented inside the EU, and the others are not coming with us, especially in the not one overseas. And our companies now get into an even more difficult situation. So instead of improving business environment, it has already been said, we created further difficulties for them. Why don't we change our mindset? Why don't we want to be the champions of healthy tax competition in the good sense? Why don't we try to attract companies by offering excellent, simplified, and low tax schemes? Because maybe that would work. I know all the problems, profit shifting, all this. But it's a clear failure what we have done so far. The second, the original agreement was to have Pillar 1 plus Pillar 2 at the same time. What happened? We are nowhere with Pillar 1, only with Pillar 2. Again, it's impossible. So I just very much hope that we will not create further difficulties for ourselves. Mr. Angel said at the beginning that actually the Commission doesn't really have plans to modify the directive. But this year is the year of the omnibus legislations. 1, 2, 3, 4, 2,926. Couldn't we have maybe one on taxation? Thank you so much.
Thank you, Enika. And look around, it was less directed to one, but maybe on the tax omnibus we can start, and then the people raise their hand.
One remark before going to the tax omnibus. Taxation matters also for raising the necessary resource for ensuring competitiveness. Now I'm a tax director, but I've not always been in taxation. Before I was dealing with other issues, including investment. If you look at the countries which attract the most FDI in the world, among the OECD countries, it's the United States, it's Germany, and France. None of the three are low tax jurisdictions. If you want to attract FDI, you need plenty of things. Tax is just one element in a much bigger picture. You need good infrastructure, you need good education, you need rule of law, you need a well-trained labor force, etc. All this has a cost for which you need tax resources. So the main advantage of Pillar 2 is to create a floor to tax competition. It does not prevent tax competition, but it does allow each country to secure a certain level of income from corporate taxation, keeping in mind that corporate taxation itself is just a small part of the resources of our member state, because we always obsessed by CIT, but actually if you look at the resources of our member state, in the EU, in average, the CIT is 6, 7, 8%, depending on the country, of the tax resources. Now, moving to your question, simplification is extremely important, and there will be a tax omnibus next year. We are working on a systematic review of all tax legislation in the direct tax field, and the proposal will be on the table somewhere in the middle of next year. I must say this is a difficult exercise because we are sometimes struggling in between. On the one hand, sometimes excessive expectation from businesses, not from Lucio, but some businesses tell you,
I am fundamentally a reasonable person.
Absolutely. You just have to delete all the anti-tax avoidance directive? Well, no. But also, on the other hand, an excessive conservatism of some finance ministries and tax administration. We have heard recently some countries telling us, yeah, simplification, we're fully behind it, but on one condition, it should affect neither the tax income nor the tax IT system. Well, good luck to find a tax measure that has no impact on any of the two. So clearly, we need, on the one hand, the businesses to be sensible in their expectation, and on the other hand, we need member states to engage seriously and accept that if we simplify, we have to let some element go.
We echo that message to the member states. And then I have Dr. Kimberly online.
Thank you so much. I just wanted to agree that I do think there are so many other non-tax aspects of competitiveness that are really important in today's environment. And the EU isn't alone in, creating instances of self-harm. I think the United States closing itself off with these isolationist policies against not just trade, but the talents of the world through immigration, I think that creates a much more difficult time for the U.S. business environment right now. And, I think by focusing on the myriad aspects of making a strong business environment, I think the Europeans could, in fact, make a lot of strides in the years ahead. because they are open to the world in terms of trade. And trade and investment really go together. More than half of U.S. imports are intermediate goods that are used in global supply chains. And so we're giving ourselves in the United States a big competitiveness disadvantage by making imports from everything from metal to parts more expensive. So this, provides an opportunity for openness in other countries to provide an advantage. Finally, just two real tiny things. One, I think on the evidence on profit shifting, all of my data are from the OECD's study on this that is very recent that indicates this is still a very large problem, but I would point to other sources and footnote 1 on that as well. And with respect to global averaging versus country by country, just a very quick point there. If you're on global averaging, right, then you can get it so any place in the world your average tax rate gets down to 15% because you average the high tax with 0. If you're in country by country, 15 is the bottom, but there's still other high tax countries in the world. So that's definitely a disadvantage relative to the most aggressive blenders under the U.S. system. Thank you.
Thank you. And shortly.
Many thanks. Just a fast point. While it's obviously true that there are other factors beyond taxes that affect an investment location in an investment decision in a particular location, taxes by definition are one of those. Let's assume that you have market A and market B, ceteris paribus, everything else constant. If they provide you with the same level of infrastructure, quality of labor force, connectivity, etc., you are going to invest on the one that has the lower taxes. So this is obviously a factor of decision for companies when they engage in investment. It's one of many, but is one of the most important ones. One final point, if I can, on the fleet of omnibuses. We engage in significant resources to cooperate with not only the Commission, but with the co-legislators on the particular omnibuses which are relevant for our members, and we look forward to do exactly the same thing when we have the taxation omnibus during the course of next year. Many thanks.
Thank you very much. And then we move towards Rasmus Andresen from the Greens.
Thank you so much. Just would like to start out echoing what Mr. Parinello said, like at the beginning. I also think that it makes a lot of sense to stick to a lot of arrangements in the OECD agreement, even if, of course, it creates a lot of problems. We can see with the current administration in the US, because the design of the agreement, the different elements in the agreement, but also the goals of it are not depending on one very important, of course, region of the world, but there are others to deal with as well. And this is why I think it will be quite important what the OECD also has to do in the next weeks and months on this one. But I would actually also like to ask Mr. Angel and I think also Mr. Parinello on one different layer in this, where I also think the tax implications of the Trump administration or the Trump administration's tax policy has an important implication, and that's at the United Nations level, because we know that there are important discussions also ongoing there, and I would like to get your remark on this, what kind of developments you see there, and also especially to Mr. Angel, what kind of positions the EU Commission is taking in the work there right now. And secondly, to Mr. De Souza from Business Europe, I think we can agree on that our tax system should be much easier, and I also think that we can agree on equal burden sharing. But if we can agree on this, and we on the other side also can agree on that we need to see private investments coming, but also public investments organized at the European level, for example, for research or strong competitiveness fund, I know Business Europe is also in favor of, then I think we also need to have an answer on the question question where the money should come from. And if you don't want to see it coming from big business in Europe, then my question is, would you like to see the money coming, for example, from the big tech industry in the US? I mean, Business Europe could be much more vocal, for example, on calling for a digital services tax, knowing very well that the investments, the revenues we can get out of it, we could invest in Europe and we could use to strengthen our competitiveness.
Thank you very much, Rasmus, and I'll hand the floor over here first. And in the meantime, ask Regina if she would be so kind as to replace me for the last two speakers. But I hand the floor over to you first, Mr. Bismarck.
Many thanks. This is a MFF type of a detour on the discussions, but this is also responsibility of my department, so I will gladly reply. And many thanks also for the previous interactions that we had on this subject. Allow me to put it this way. I will start with the core proposal on the MFF, which you implicitly refer to. An economist, and I will give you a reply that I would give regardless of organization that I'm linked of, knows that taxes must be incentive compatible. What I'm trying to say with that, the core proposal is a turnover tax. The practical implication of that is that in principle you could have a company that is loss-making, that is not making any money, and that would still be liable for the payment of that particular tax. From a share point of economic logic, if you are designing a type of tax, should be in a measure like profit, because that is a better way to make the tax both sustainable and incentive compatible. As I indicated, there is a clear logic behind the position of Business Europe in relation to the proposals that you had on the MFF own resources decision because of the nature of the tax instrument which is being proposed there. Your point on the DST, and we actually had this conversation before in a different context, you are not only going to be taxing American companies, you are going to be taxing those that are the users of the services provided by those companies. What is going to happen is that the costs that one could imagine are going to be restricted to the other side of the Atlantic are going to be transferred to us as companies and as customers, which means that in the end of the day, we all will be paying for that. If you allow me just one final conceptual point between the additional own resources that you have on the Commission proposal, the scale of the estimated revenues, and the usage of them. The reason that is presented by the Commission for the own resources decision, the new set of taxes, is essentially to cover for the repayment of the Next Generation EU. A simple arithmetic exercise would show to you that if you take seriously the estimations of the Commissions in terms of what is going to be collected from those taxes, you have more than twice what is necessary to pay for the Next Generation EU. Now, if that is the aim, only in terms of supplying resources for the usage of repayment of the Next Generation EU, the Commission proposal is significantly overtaxing beyond its stated objectives. So that's also a conceptual point from our side.
Thank you, Dr. I now go to Mr. Parnello, please.
There was a question.
Thank you very much. Thank you very much for both questions. There were a number of questions within your query. I'll try to summarize them. On DST and the UN, I think it also shows, to answer some of the queries and concerns that were stressed before, that if you disregard the issue of profit shifting, it comes back through the window. And we're typically in a moment where DST are not what economists would say a perfect instrument to tax companies, but they're a proxy to approximate, the second best option to approximate the way to tax properly big tech companies. They're not what should be the outcome of a proper international cooperation agreement. but that would mean redesigning taxing rights and how we tax profits across countries. This is part of the conversation that could happen at the UN, and I think that the very existence of negotiation at the UN show that there's discontent with what happened at the OECD from a number of countries, and we cannot disregard the willingness of those countries to actually want to redesign the rules. They're going to account for a significant share of a global GDP in the years to come, perhaps bigger than Europe, perhaps bigger than the US. And what it seems to me is that there are two options, either not entering into a relationship with the UN tax negotiations, and the result will be an even more fragmented global tax landscape, or engaging in good faith and try to secure agreements that make sure we tackle both profit shifting and ensure reasonable competitiveness, good competitiveness for businesses both in the EU and beyond.
Thank you. Ms. Rage?
Thank you. Before saying a word in the UN, let me just say a small word in defense of core. I would not expect anyway businesses to be happy with a tax proposal by definition, and no tax proposal can claim perfection. But two things I would like to say on core. First, it's simple. It's maximum 0.1% rate. And second, I understand as an economist that taxing turnover is not great, but when you do it at the union level, it has one comparative advantage, which is very strong compared to a profit tax, which is turnover is an observable variable. You don't need any discussion to know what the turnover was. Profit is not harmonized, because corporate taxation is not harmonized in the union. So if you build an own resource on profit, you have as many calculations as you have member state. If you build it on turnover, then you can know the result immediately. So I'm not saying it's perfect, but that's one of the reasons why this choice has been made. Now moving to the UN. It's a very difficult forum for us, and it has two major differences with the OECD. The first one is that it works primarily with simple majority. And simple majority can make a lot of sense in many areas. But if the idea is to prepare a tax convention at the end, and if we are still in a process where, to cut it short, all Western countries are outvoted at each and every vote, what is the likelihood that these countries effectively ratify this convention? Because the convention needs to be ratified. By comparison, the OECD works primarily with consensus. So it is extremely difficult, it's slow, but it creates a situation where there is a bit more ownership at the end of the process. So far, we have had difficulties to be heard at each and every step. It has improved a bit in the last months, but it is still challenging. The second difference is the support to the process. The OECD work is supported by a large, highly competent staff. So each time someone asks a question, usually you get a lengthy answer from the OECD, very sophisticated, very complicated, probably too complicated sometimes. But there is no shortage of expertise. In the UN, it's a bit the opposite. So far, the staff supporting the process is extremely light. Which means that the discussion remains very high level with a lot of political statement, but not much concrete text to read. So you have three processes which are ongoing. You have the Framework Convention, you have the first protocol on the cross-border services, for which the immediate question is what will happen to the OECD Pillar 1. Because if the OECD Pillar 1 restarts, then we have a problem of somehow duplication of the work. And you have the second protocol, which is dispute resolution, which is a protocol in which the European Union and its member states are a bit more interested. And the work on this work stream is even led by a European Union member state. It's led by Germany today. As you said, we engage in earnest. We engage in good faith. We will make effort to try to get to somewhere. But I should have said that there is a third important difference with the OECD, and this third important difference, which is not to be underestimated in the tax field, is that the United States are part of the OECD discussion. The United States are no longer part of the UN discussion. So you may wonder, for instance, if you have a protocol one day on cross-border services starting with digital without the United States, it's a bit challenging, let's put it like this.
Thank you. I now call for the left, UC Sarmo, please.
Thank you, Madam Chair, and thank you for all the speakers. Actually, my question was about UN Convention, and that's now I'm trying to get myself. Actually, I feel like we should go back to the basics after listening to many speeches today, because, like, why do we have taxes? Why do we have European business? Why do we have European Parliament? It's to make people's lives better. All these man-made structures, and if we watch which countries are the happiest, best for the people in the world, they are actually European countries that have relatively high taxation and very good public services, and actually they also have a very good competitive businesses usually. But the problem is that the competition is unfair, and the multinationals they are winning, and that's the main problem. The Hungarian example here was mentioned. Well, the Orban gets 27% VAT from all the people, and even the CIT rate is 9%. It's not like they are getting a lot of investment outside, so clearly the Hungarian model is not working. We don't want to be China, definitely we don't want to be China, and we cannot be the United States printing dollars, and we don't want to be the United States, so what should we do? And now it's clear that Donald Trump doesn't want to do anything. Like in the end, we are not going to get a fair system with Donald Trump. So we should act, not wait. With UN, I don't know. Well, Trump is taxing the trade surplus with tariffs, but we are saying that we don't want to tax the service surplus because Trump doesn't want us, or the European business doesn't want us to do that. So what can we do? I think the Commission answered in the oral question in the plenary that we need a multilateral system, and that there might be something going on, and there should be something going on with Pillar 1. So I'm asking, what can we do without the United States? Like, if we want to cooperate with the rest of the world, because the other option is actually that we are not really doing nothing, just 5 more lost years. Thank you.
Anybody want to take that first?
Just
Mr. Angel.
something I wanted to say, and I didn't have the occasion, but it was mentioned briefly by Kimberly as well. The impression that the Europeans are alone on Pillar 2 is deeply mistaken. We are not alone. Actually, if you include in Pillar 2 the qualified domestic minimum top-up, which is one component of Pillar 2, you have 60 countries which have legislated. Okay, that's not the full planet, but how many international tax agreements have already been supported and subscribed by so many countries so quickly? I think it's important to keep in mind that today we have countries implementing Pillar 2s on all continents. UK, Canada, Australia, New Zealand, Japan, Korea, South Africa, plenty. On all continents you have countries implementing Pillar 2. So what we're facing is a complex discussion with the United States on how to ensure the coexistence of the two systems. We have indeed a certain reluctance from China and India, even though they do participate in all the discussion and are even part of the steering group, to move to the effective implementation stage. At the same time, we have to keep in mind that neither China nor India are low-tax jurisdictions. India is a very high-tax jurisdiction, actually considerably higher than we are ourselves, and China itself is, let's say, more or less comparable to the EU average in terms of taxation. So we're still working on it, but it remains the best shot that we have for an international cooperation in the tax field.
Dr. Lucio?
Many thanks. I feel compelled to give a reply to the core question, starting with a small observation that if you went through it because it was an easy tax, it was the very first time in history that the Commission did something because it was the easy and simple one to do.
We listen to you.
Finally, well, not exactly what I wanted to happen, but anyway. So the point in relation to taxation overall is a disincentive from the point of view of investment and competitiveness. Whatever is the underlying mechanism, this puts us as a disadvantage. In the end of the day, it is as simple as that. On the point that you asked of what can we do, we can do plenty. We control what we do in our member states. It's our choice to be more competitive, to invest more in infrastructure, to invest more in education, to have more effective and simple tax systems. This is all under our control. The easiest thing that we can do in the end of the day is to keep our houses in order in terms of investment climate, in terms of infrastructure, in terms of fiscal sustainability. For this, in the end of the day, we really don't need others to be doing things for us. We control our own destiny in the end of the day. Thank you so much.
Mr. Parnello?
Thank you very much for the question that also helped us take a step back. But first of all, on the UN part, and just wanted to build on what Benjamin said on the US. For sure, the US is not part of the UN Tax Convention conversation. It is part of the OECD inclusive framework, but not engaging and just there to secure exemption for their own regime. I think if you look at the future of international tax cooperation, the question is, will we be able to secure any kind of agreement with all the countries in the world? And if we look at history, there's a very limited example of international tax cooperation agreement with all the countries in the world. What works is international agreements that are designed to prevent one country from blackmailing the other. And this is how Pillar 2 was designed in the beginning, with the interlocking rule system. If one country doesn't want to participate, it is fine. Another country will step in and make sure that the company plays on the same role than the other. And if I look at the future of tax cooperation, I think that this is the kind of system we should redesign, make sure that wherever the company comes from, if the company wants to access the European market, we need to make sure that they play by the same rule than the European companies who have trade mechanism to make sure this is in place. We need to make sure this is in place for Chinese companies. We can make sure this is in place for American companies accessing European markets. It's about making sure everyone plays on a level playing field. Thank you.
Thank you. We're finished the first round, and if I know we're over time, but if I wonder if I can just have people's indulgence for 1 minute to ask a quick catch the eye. I think it's to you, Dr. Lucio, because given that our weaknesses were laid bare, the EU weaknesses were laid bare during the summer, I thought your contribution on the SIU was quite interesting. I know tax is obviously a member state competency, but what do you think member states should be doing to make the SIU attractive? In Ireland, for argument's sake, we have 41% exit tax on dividends and gains on EFTs, which we're clamouring to try and get changes for. But given the blueprint has been leaked, what is your view of the ambitions, and what do you think member states could be doing individually to make sure that it is attractive and it is ambitious and successful?
Many, many thanks. The SOU, the Savings and Investment Union, is also one of the responsibilities of my department. We're actually in the process of preparing our position paper in relation to the SOU, given the upcoming first package of the Commission, which is scheduled to come next week, as a matter of fact, and then we're going to have 2 additional ones by the end of the year. The one that is coming during the course of next week is in relation to the savings and investment products, the more investment-centric ones. They are coming later in the year. So in practical terms, we have a fundamental problem in terms of the way that our financial system operates, on the sense that we actually don't have an integrated financial system. There are many, many reasons for that. You just indicated one, which is related to the exit costs that a company faces in relation to investment. One of the reasons for that is because our products, they tend to be linked to specific pools of liquidity, which means that anything else, investing and exiting of that limited pool of liquidity is going to be more costly than if you are dealing with a deeper and more diverse pool of liquidity. So the fundamental question for us is to try to make our financial markets truly integrated financial markets, which offer different types of services and financing providers to whoever is the user on the other side. We are here 20 years after the creation of the euro area. There is no single euro area-wide bank. We essentially, in the end of the day, still have national banks. Our banks, they don't mobilize the type of pools of liquidity which are the core of the US system, pensions, for instance, which tend to be linked to certain types of products which, in the end of the day, prevent you as an investor, you as a server, from benefiting from the gains that you have from applying these on markets. So the real answer that we have is to make our markets integrated and deeper. And then the costs of entering and exit from the point of view of whatever is the product that you are talking about are going to be lower, and therefore they will benefit you as a saver, households, and companies across the EU. Thank you.
Sense. On that note, I'd like to thank all of our guest speakers for their availability and their openness genuinely in the replies to the questions that were put here today. I'd also like to thank the audience for their interest and their attendance, and the interpreters for their excellent work. Today's hearing has provided valuable insights I know that will be further discussed during the upcoming FISC mission to Washington and New York at the end of October, where our members will engage with stakeholders and their US counterparts. Finally, our next meeting will take place on Thursday, the 16th of October, so I look forward to seeing you all then.